Hello, this is Peter Bell, and I'm here with Mr. Jerry Huang from Gold Drilling Corp. Hello, Jerry.
Hi, Peter. Thanks for taking the time.
So, what a treat. I've got a copy of your financials up. I'm recording the broadcast, and you've got a copy there as well printed out.
I do. Yeah,
So, I gather there's some growth happening in this side of the business.
definitely.
Congratulations. Regards to Frederick Davidson and the company.
Yeah, I mean, there's definitely growth coming throughout the diversified sector, which is a nice change of pace, obviously, amidst a general slowdown in the mining sector. Total revenue, Peter, as you mentioned, it's up again year over year. It's a 12% increase from 2017 of 75 million, going back to 2016, which is another 15% year over year increase there. In 2016, we only did a multi-year low of 65 million in revenue and about half that in mining. We continue to see growth coming from the non-mining sector. So energy infrastructure, diversified, so sustainable drilling, even drilling for HDD, fiber optics, and 4G cables across Canada and North America was about 35 million in 2018 versus 23, just under 23. So that's nearly a 50% jump year over year. We have a manufacturing division which increased 40% year over year and actually made money in 2018. So that was a significant turnaround. Mining revenue actually went down a little bit, down just up below 40 million in the year from about 45 in 2017. And that's really just largely due to details I'll go over in a later segment, but mostly increased competition and just general slowdown in some of our South American divisions. The green drilling division, as Peter said, is one of our highlights of the year. The green drilling division, I want to just kind of describely, this is the geothermal infrastructure, drilling for HCD segments as well. And that's actually nearly doubled year over year. So for the year, we actually saw performances well over 19 million, nearly 19.7 million versus 9.7 in 2017. That's over double year over year increase. And we're seeing that increasing throughout North America as well. This is the feed building sectors, building codes, even new condos and townhomes require them. So we obviously are not servicing mom and pop buildings. We're servicing larger commercial size real estate, larger multiplexes for tech offices in the US. Very good margins, very steady. We generally are subcontracted from larger companies like SNC, Stantec, engineering companies that are basically tasked with building an EPCM for a lot of these larger projects. Our horizontal directional drilling, which is a company we bought 3 years ago in Manitoba. Horizontal directional drilling is to do with hydrovacs, drilling for directional beneath city blocks. And Peter, that enables a lot of companies like telecom companies like Rogers, Bell, TELUS, for example. We were drilling in Richmond last month for households. And what it is, we all have smartphones. We all want faster internet speeds. But with the Wi-Fi and increased connectivity, coming with 5G and 4G, you have to realize a lot of the city blocks were not built in 2000s. They were built in the 50s. There were no Wi-Fi and wireless networks back then. So in order to bring fiber optics, 4G, to more population in North America, we require a lot more retrofitting. And that's where HDD comes in handy. Rather than digging up city blocks of concrete, you see these trucks coming in around downtown, around city centers all the time, more and more often now. And that's what we do. We have hydrovac trucks, and we have these directional drills that we're not drilling for mining, we're not drilling for oil and gas. It's certainly a very similar technology, but they basically ream out and with water clean out the underground pipes from in the 50s, where they have just natural gas and maybe some electrical lines, and basically ream it and add in a new fiber optic line or a new 4G wireless cable, which then allows that whole neighborhood to be retrofitted. So, for example, case in point, TELUS under basically subcontracts through Ledcor. We all know that very well in BC. They would pay anywhere from $3,000 to $4,500 per house. And so if you can imagine just a block of 20 houses, you're getting revenue of anywhere from 50 to 100,000. And that's what we do for the HDD sector. So that sector last year in 2018, we did just under 7 million in revenue. That's compared to 3.6 in 2017. That's again another double of revenue size year over year. Gross margin for the business overall for Energold in 2018 went to 17% from 14%. The margin for mineral is still pretty low, to be honest. We hit a high of over 35% back in 2012. We're still clawing back all the way down from 12% in 2016 to about 15.5 last year. Manufacturing business actually was 24%.
The mineral drilling, it's still profitable for you?
Mineral drilling is profitable on a gross margin basis. After G&A and just miscellaneous amortization costs and everything else, not quite. Manufacturing business was 24% last year, and energy was actually around 16% as well. So, I mean, back to your question.
How many of those are profitable too in energy and infrastructure? Or is it?
So energy and infrastructure are actually profitable on a cash flow basis. Net loss, though, for the year is still significant, and I can go into that detail a bit later. But the net loss was dropped quite a bit to 14 million for the year versus 17, 16 year before. Now with the adjusted amortization, and that stands for adjusting for depreciation, another word for amortization, interest expenses, taxes, and wear and tear, we wrapped up the year at 2.9 million, which is a huge jump from the last few years. And amortization, it's heightened, I would say, for Energold largely. So you can see the numbers there on the screen. Amortization almost jumped in half. And this year we're actually seeing positive EBITDA as well, which is the first time in since 2012. So 3 quarters into 2018, we saw positive EBITDA for about 2.5 million. Q4, as the seasonality goes, it's usually slower, and that's why we had a bigger loss since we're mobilizing in the oil sands. Our oil sands divisions cost a lot more in the winter seasons in November for mobilizing for the January frozen tundra startup in the oil sands. We should envision a lot of that cash flow coming back in Q1, but Q4 historically is always a bit slower, and that's why we had a drop in the EBITDA.
On an annual basis, that oil and gas business, that's profitable as well.
Yeah, oil and gas, it's definitely a good sector. This year, I think it's actually slightly negative.
If you're making a profit in oil and gas, right? Yeah, it's been a very wild year.
Yeah. I mean, as you know, 3 years ago, oil precipitously fell to below 30 a barrel, and I think most of our E&P players and clients just froze like deers in the headlights. And since then, it's come back quite a bit. I mean, not to say things are not better, but I mean, the fact of the matter is our utilization is doubled year over year. We have on the oil sands, we have 12 oil sands coring rigs, and we have 6 of them working last year. This year, we envision even more. And if you read the headlines, Chevron, Cenovus, there are larger companies like Shell and Husky divesting oil sands assets. But at the same time, if you look at CAP, which is the Association Canadian Oil and Gas Producers, they put out great research, and forecasting to 2035 to 2040 in Canada, already as it is, oil sands represents 2/3 of the existing output for oil, in Canada, and going forward, that's only increasing. In addition to that, it's still the 3rd largest oil and gas reserve in the world, behind the Middle East and behind Venezuela, which, as we all know, it's a lot more politically charged than Canada. So the main thing, obviously, right now is having some more clear optics on the pipeline situation, which I think in the last 2 weeks, Peter, under the new conservative government and Mr. Kenney in charge, it should be coming a lot sooner than later.
Let me give you a totally off-the-wall idea, Jerry.
Okay.
Suppose last year you had 6 of those rigs working and 6 of them sitting idle. Imagine if you raised risk capital in some way to fund, Wildcat exploration work
Right.
using that idle equipment, like, and
That's a good
is
idea. Yeah.
that
Yeah, for
is that
sure.
something you do on a going forward basis too? Like, I don't know if you want that on your balance sheet necessarily. You
That's
might,
probably the toughest thing. Yeah, it might be more qualified to spin that out into a junior or CPC
or
dealer.
or
Yeah,
to
I
do it
mean,
privately, right? I don't know what kind
yeah. I
of
mean,
private
that's an
market
idea.
activities you guys are
Yeah, I
doing,
mean,
but
as you probably remember, we have a bit of convert debt maturing next year on the books because we actually acquired the oil and gas and oil sand service company in 2012 with a convert debt to pay it down. But yeah, I mean, it's definitely an idea. I mean, that's actually how Impact Silver came to be. Was Energo was drilling extensively in Mexico in the late 90s and came across great projects that Group of Mexico and Paneles operated and
yeah.
built infrastructure around, and simply bought the project at a very good price from a previous operator who ran it into the ground with 3 4 month mine life left. And today,
Oh.
Impact has now produced over 9 million ounces of silver with no debt. So, I mean, again, but the thing is, end of the day, Energold is a drilling service company. So
Yes,
whether it's mining
yes,
or oil and gas, most investors invest in a service company to get away from the up and down of a resource cycle. So
and
obviously, we're very leveraged, right? I mean, 2016, when mining came back briefly, we were up 5 6 times from 20
yeah,
cents.
yeah,
So we won the TSX Venture 50 that year, and also our seed company Impact also went up even more. But I mean, even on mining alone, with 139 drill rigs, we average about 100 million in a peak of a mining cycle. Last year, as I mentioned, we did 39. So if you just kind of work it backwards, that's like 30, 40% utilization at
yeah,
best of our
yeah.
rigs. So we have a lot more room to go. It's just that when will mining finance come back? When will the juniors come back, right?
Well, and to some degree, that's a question of what investment products are available to mining investors, right? And if you
Yeah,
can go to private markets and say,
exactly, exactly.
Slack at a discount, like,
Yeah,
or
that's right. So while we're on this page, I want to mention to your readers and viewers as well is on our adjusted EBITDA. I mean, you can see finance costs and amortization is a huge part. And finance costs is our bank interest charges, our convert debt, arrangement fees. So, I mean, without a lot of this, and amortization, as you probably know, it's an accounting creation, right? I mean, if you had a car for 5 years for $10,000, every year on paper, you're losing $2,000. It's not $2,000 coming out of your pocket. The car is perfectly fine. But in accounting treatment, we need to adjust for that somehow. So the amortization has been huge. It's north of 10 million for the last few years and over 8.4 the year before. That's starting to drop. And I think that would also help us show net income in 2019 as things continue to improve. And that's something I want to point out. And that's why
10
between the net
million.
loss and the EBITDA is such a large jump. It's like a $10-12 million jump, largely because of these charges that are largely non-cash.
And the amortization running at 10 million a year. When was
Yeah.
that?
If you look back, I mean, how that came to be, again, it's a IFRS accounting CPA CA treatment. We also had that retreatment this year with our inventory going to long-term inventory.
Yeah.
With amortization, how that worked is we bought the oil sands business for 15 million consideration, which was paid in half cash and half shares in 2011. What the accounting treatment was deemed at the time of acquisition was that we bought it at a discount. We ended up paying over 37 million at the end of the day through combination of the cash, shares, and earnout. Right? I mean, the whole point of an earnout is that you have a 3-year earnout, 4-year earnout, so that the owners of the business that sold the business to Energold would stay on board as management, and they still are on board, stay on as management to transition the process, to transition the business, and they have to fully transition the business in the next 3-4 years and continue to show the metrics to deliver earnings. Otherwise, they don't get the full benefit and full bonus. So they did exactly that. But because the face value of the acquisition price at the time, the business was worth over 50 million. We bought it for 15. So basically, we made 35 million on the acquisition. If you look at 2012, we had like 30 million net income.
Oh, Saying
because
that you had to
we've
amortize
made
that
money.
too, eh?
We've made money buying something cheap, and supposedly we can sell for higher, right? So that's where we've been amortizing this down for so many years.
Yeah. Meanwhile, what's that business worth now, right? Right in
Um,
2012, oil
yeah,
was
yeah,
a
yeah.
very
Well, I
different
mean, that
proposition from the last
business,
year.
I mean, you still see it. Like we're doing under
Yeah,
40 million for that, and it's
not
even a
bad.
positive as a standalone.
Good. Yeah, thank you.
BDI and BDC. So BDC is the Canadian version division for oil sands and geothermal and seismic. And BDI is actually doing really well. The seismic and the geothermal infrastructure drilling in the US, that's 17 million a year right now. I mean, that used to be a second season. It used to be kind of the redheaded stepchild of the business. And now that's actually the all-star. Oil sands is kind of lukewarm. I mean, it's coming back,
And
and
did they come together?
it is getting
Did the two,
better. But
did the two
yeah.
business lines come together in the acquisition?
Yes, yeah, that was all part of Bertram. Yeah, so Bertram has been around for 55 years now. So that's one of the major acquisitions we did. The other one was a manufacturing business, which if you saw the press release, we turned it around in very quick time frame. We jumped the revenue up almost 40% year over year. Cut out a lot of the fixed costs, changed it to variable cost. And earlier this year, we actually sold it to a group with a very extensive manufacturing business from Caterpillar. So they bought it for 5.7 million, and it's payable over next few years. Every 9 months, they're paying us 800,000 or so. But again, the crazy thing here, Peter, is that between that asset and some of the assets we hold on the balance sheet, that's barely worth slightly more than what the market cap of Energo is trading at right now.
Yeah, of course.
Yeah, I think, and then I think that's where the opportunity is. I think the market is giving Energo no value for
Yeah, literally.
mining business, and even more so, even no consideration for our diversified growth. I think people still think Energo is a mining driller, but as I mentioned this year, more than 50% of the business is now non-mining.
What is the utilization rate there on that redheaded stepchild in America? Your formerly.
Yeah. So for BDI, if you kind of just look at maybe you go to page 2 of the segmented information, there's a bit of a segmented breakdown of the meters drilled year over year. That's increasing quite a bit. You can see that quarter over quarter, the drilling size has increased. Utilization is, I would say, generally over 70% for our BDI division.
What page? I don't have it. Sorry.
Oh, sorry. So if you're looking at the MD&A, it should be just page 2. You'll see that select operating information. Yeah, just right here. So you'll see that energy fleet. You'll see that. I mean, that is consolidated. So you'll see water, geothermal, geotech, horizontal drilling all included in there. But you can clearly see the numbers are jumping out over year over year and quarter over quarter.
Yeah, that's a growth. Is there growth happening there?
Yeah, definitely. So you'll see that infrastructure drilling. If you go to page 7 now as well, you'll see that even more clearly. I mean, we actually break it down. So infrastructure drilling is to do with civil engineering when there's new buildings being built, geotech, drilling for foundations. Largely speaking, Peter, these are very transferable drilling expertise. If anything, mining drilling and oil and gas drilling is a lot harder, right? If you imagine drilling for coal, it's pretty simple. There's far less complexity drilling for coal versus drilling for gold or copper. There's no alterations. Coal is coal, right? It's very consistent. You just have to find the seams, and you pretty much just export it bulk tonnage. Whereas with gold, there's dipping, there's pinching and swelling effects. There's different contaminations. You got to find the porphyry. There's all these different. There's leach caps and oxide caps. Oh my God, it's a whole slew of things that can change results. So for infrastructure drilling, it's pretty simple. It's geotech. You're testing the soil, the consistency, the competency of the ground to support weight for foundations of building. Oil sands, you can see for the year ending, it's up 50%, about 30, just under 30,000 meters from about 20,000 meters. And then sustainable drilling, that's where we really hit it out of the park. It's a double year over year. And as you know, in mining, in drilling, for the most part, we charge by the time, the standby, wages for the staff. There's mob in and mob out. And for the most part, these are not hard to access places. We're not talking about mineral drilling where we're drilling in Guinea or drilling in PNG. We're not drilling in Africa where you got to get a helicopter to move into a forest or anything. These are for the most part by the side of a highway or in city blocks. So sustainable drilling is geothermal. We're drilling for city blocks, new buildings, multifamily units for townhomes where they're using heat pumps and passive geothermal loop heating, which basically is a glorified radiator. You have a heat pump, and you'll start to see this more and more often, even in BC, for newer homes. And it doesn't once it's installed, it's very passive, right? Like it's just a passive loop geothermal where it goes down 50, 70 meters. And at that depth, you'll realize, Peter, the temperature of the earth starts becoming apparent. I mean, as you've been underground before, I'm sure in mines, at 100 meters, 200 meters, temperatures has gone up by about 2 to 3 Celsius already. So if you circulate radiator fluid, essentially a glorified radiator fluid, down 300 meters, you're going to get enough temperature gradient that in the summer it cools you down, and in the winter it actually heats you up. So if you do that on a large enough floor speed basis, it's a huge amount of savings at very, very little expense, which is really just the cost of the heat pump.
All you need is some rock to drill into, right? There's a lot.
Well, you just need depth. Yeah, that's geothermal. Like as you go lower, going to the center of the earth, it's going to get hotter, right?
What is that? $1 million business line at this point, or?
Oh, it is. I mean, sustainable drilling, as I mentioned, it was 17 million last year.
Yeah, it's a wonderful line item to have in that
not a small chunk anymore. Yeah, no, exactly. I mean, yeah, it used to be like a cute little division when mining was 100 million. Oh yeah, that's great. Like if you guys do that too, that's perfect. Well, now it's becoming a material division.
And it could be a global market too, right? Like
it is actually, yeah. There's some research out there. The U.S. geothermal market is one of the fastest growing markets out there. It's not the biggest in the grand scheme of things. I think it's going to hit like 3 billion in 2019. But hey, there's not a ton of players in that sector, and you got to put that in perspective. I mean, a few billion it's a drop in the bucket for most consumer markets. You got to keep in mind global mining drilling exploration expenditure from S&P report at PDAC 2019. Global mining expenditure barely cracked 9 billion, right? Global, like this is just geothermal in the U.S. We also do geothermal expanded this year to Panama and international blocks as well. So, I mean, we're using Energo's international reputation and logistics to expand beyond just North America.
You have that. You have that.
We do have that, exactly. We were drilling for geothermal this year in Panama.
It's wonderful. And again, is that in terms of infrastructure or utilization ratios and stuff, that's fairly high?
It's definitely pretty high. Yeah, I mean, where the rigs are getting mobilized from for sustainable drilling, Peter, is it's actually the same oil and gas rigs and the team we have. So with oil and gas and oil sands, the peak of the oil sands season, as you may know, is November to March before spring breakup. And what spring breakup is the Chinook season comes through the valley. It warms everything up. So you're going from like -30 in Fort McMurray to +5, +10, and at that point everything starts thawing and the ground starts melting. And when you're talking about 80, 150 ton rigs, you're starting to sink into the ground. So it becomes unsafe to work. These rigs can tilt over. So spring breakup comes, and for the most part, historically, a lot of the oil sands service companies, they lay off all their contractor staff. A lot of the staff come from East Coast. A lot of very good drillers actually somehow all originate from Quebec and Ontario. So they simply go back home to farm, to fish, take the year off. And in the good years, the oil sands industry was paying very, very well. So people will make multiples of what they make in other lines of businesses for 4 months of the year, and the rest of the year they take time off and do some contract labors. So what essentially we've done is with the geothermal and sustainable drilling sector is that we've created a really tangible and material second season for that crew. So rather than getting laid off, we basically asked them to find businesses that are transferable and parallel to drilling for the oil sands, and they've done that in North America, and which is perfect because it's A, accessible, B, it's the bills don't bounce basically because we're getting subcontracted by major engineering companies. And the one thing for sure under both Trump and Trudeau is there's going to be a lot of infrastructure built across North America, whether it's a wall, whether it's SkyTrain, whether it's more pipelines, we drill for everything, right? So these are all infrastructures. They all need geotech. They all need access road drilling, highway geotech testing. The reach is it's huge.
It's amazing. I look forward to hearing a statistic like this line installed, geothermal heating for individual houses in a city of 1 million people, that they were actually able to, do a large scale project like in collaboration with like the local government, like
For sure, yeah. I mean, for example, when they had the Trans Mountain drilling up at the SFU mountain in Burnaby here, we were actually drilling geotech for Trans Mountain.
So you were in the thick of that, hey?
Yeah, definitely. Well, with the protest aside and everything, but yeah, we don't advertise a lot of these enough because we run that through Bertram, which is our North American energy services company. But I think a lot of people have a confusion with Energold being a North American driller in terms of mining. In mining, just to clarify, we don't drill too much at all in Canada. Canadian drilling is great. There's a lot of money here. There's a lot of very high-grade projects in eastern provinces, Ring of Fire in Quebec and Ontario, around the Kirkland Lake area. There's also flow-through financing, which is great, very good government initiative. But at the end of the day, it's a very competitive, saturated market. Yeah. There's a lot of great companies here. You're also competing on the smaller project side with mom and pops. So Energo predominantly, Peter, in the mining sector, we work in the frontier and the developing nations, right? So in terms of our market reach of over 25 countries, we're primarily in Cote d'Ivoire, in Ivory Coast, in Ghana, in Mauritania, Liberia, in Africa. We're across South America. We're one of the largest drillers in Mexico. We're 45 rigs there. We drill for a lot of the gold and silver companies in the area. We were drilling for Endeavor Silver, Great Panther, First Majestic, obviously Endeavor Mining in Africa, McEwen Mining, Los Filos for Goldcorp Underground. So projects like that is really where Energo shines, and really where the margin expansion comes is when the froth of the market. We have a lot more junior companies. They want the big bang for the buck. They would engage Energo because we have what's known as a very footprint-friendly modular setup rig, which enables you to really mob in, mob out with locals, right? You're using more labor than automation. So rather than hiring a helicopter with very expensive standby, you're hiring locals to basically move in 300-400 pound pieces on the back of guys on the hill. So they're moving these parts in and then just assembling it on site. So you're talking about there's no need for clear cut. So for a junior company, if you raise $1 million, more of that $1 million is going to go into the ground, which potentially means more holes, more intercepts, and hopefully one of those intercepts is the home run 5 gram, 10 gram per ton over 10 meters that you need to raise your next round of financing.
I hope that there's a mining bull market in Egypt someday that gives you guys a large amount of business too.
Oh, for sure. Yeah, we actually sold rigs to Middle East, to Egypt as well, so through our manufacturing business. Yeah, so
what about Ecuador? Have you targeted anything there?
For sure. So Energold, with our previous partners in the late 90s, drilled some of the first programs for Aurelia. And we continue. This is probably a story that many in the industry may know, but Bill Fisher and some of his team, then at Dominion Minerals, and then Aurelian, and then they, on the back of those two huge successes when they sold to Kinross, they then of course went on to found Gold Gold Quest in Dominican Republic, which is where Energold started off in the late 90s, being a mining junior. So Gold Quest became obviously a multi-million ounce deposit. Unfortunately, as recently as last half year, you know, the Dominican Republic government started reviewing all the mining licenses. So there's a bit of a potential for resource nationalism. It's obviously the risk is higher there in the area. But yeah, I mean, Energo is definitely one of probably the largest driller in Dominican Republic as well. So we drilled for Gold Quest from basically 2011 onwards, when they had a huge run, and of course Precipitate and Unigold and a few of the other companies there.
Would you go back to Ecuador or DR if
For sure. Well, I mean,
Precipitate?
DR, we still have rigs there. Yeah.
I wonder if they'll hire you too, maybe if they come with a program at some point.
Yeah, for sure. I mean, we're still looking at Ecuador for sure. Yeah, definitely. It's a smaller market, I have to say. There's maybe 20 plus companies. There's maybe
But
six that's public.
it's grown a lot too, though. There's a lot who have made applications to the government that are waiting.
Oh yeah. No, I mean, in terms of
there's a deluge coming.
Countries, in terms of country risk for political instability and corruption on the index, I forgot the exact place, but I mean, Ecuador is up there in the top 5 in terms of overall improvements in the last 2-3 years.
Oh yeah. And if they can, process through these hundreds of claims or applications that they've had, right, then there will be large amounts of money spent.
I agree.
Yeah, that's bullish. The exploration market looks pretty bullish. Nevada too. Any thoughts on that as a specific area? That's pretty competitive as well. I guess it's not really focused.
Yeah, so I mean, in Nevada, we do look at occasional projects. I mean, since we do have office in Montana for Bertram, it's a very simple move for us. I would say for the most part, though, it's well served with U.S. drilling firms as well. So, we do occasionally get contracts and do work there, but for the most part, unless it's a very lucrative, high margin contract, for the most part, we would just leave it to the incumbents in the area. And we're spread thin as it is. The main point right now for mining is to let's focus on the countries we're in already rather than going for new countries. And there's a whole process and cost to set up in a new country to bill and collect taxes. You got to hire employees and everything else.
Yeah.
For the most part, we're just kind of focused on South America, Central America, Africa. I mean, Africa had a phenomenal year last year. I think it was up 40% year over year. Since the Ebola crisis 4 years ago, Africa has been kind of in the down and under. So I mean, it's great to see that make up for some of the drops and shortfalls in South America this year. So South America this year, we saw quite a bit of a decrease from countries like Peru, for example. I mean, political change. All of a sudden, Peru went from 2 years ago being super, super hot to kind of lukewarm again. All of a sudden, just possibly due to the political changes. In Argentina, you can kind of see the same thing there too. Argentina and Chile is still very challenged. We've actually pulled out of Brazil altogether. We have rigs there and some staff and some consultants there. But if a client asks us to go back to Brazil, for example, Peter, we would ask the clients to simply lease the rigs from us and hire our staff as consultants, just largely because of the labor courts there and just the labor law in Brazil is very, very favored and skewed towards the employees.
I heard a horror story somewhere that you could catch an employee stealing money out of the till of your company and fire them, and that person could then sue you in some court and have some award made against them or something like this.
Yes, that's completely true. So I'm sure the circumstances might vary, but I think the overall gist of it is that the wages might seem low on first glance compared to developed nations, but I think what it is that for certain parts of Brazil, unfortunately, when the labor courts are adjourning, the employees are essentially, even though if you dismiss the employees on a very fair grounds of misconduct and everything else, but on top of that, they would basically sue you for multiples time of their annual salary. And as I mentioned, the labor courts are usually in favor to the
Whoa.
employees more, and whether there's a joint interest there somehow behind the scene, but more often than not, they'll settle at kind of like a compromise middle of the ground, which is still multiple times of their
Yikes.
salary. So
That's
it
terrible.
ends up being a very costly exercise to even lay people off. And I'm not just saying this, but you'll see that other than a lot of local service companies, most drilling service companies actually have left Brazil altogether. Like I'm speaking about larger drilling service companies like Major Drilling,
Yeah.
which does about 4 times our revenue and about 3 times our rig size, and they've packed up and just left Brazil altogether as well. So it's
Yeah.
not just
Terrible to hear it.
us saying that. It's Bort Longyear have done the same thing. Bort Longyear is formerly $1 billion plus market cap drilling company with over 1,000 rigs, 30,000 plus employee, in financial trouble as well. They owe a lot of money. But largely speaking, specific to Brazil as well, they've also managed to not do very well there too. So
Yeah.
that's like 3 or 4 I can name off the top of my head. So I can't say that can't be coincidence, right?
Yeah. Yeah. No, it makes you want to do business in places, with some rules and some.
Yeah, not to say that's not the case, but I mean there are great companies doing good jobs, and in I mean I'm sure Equinox is doing well and finding success, whereas the various iterations of Luna Gold's on surface seems to not have.
There's so much to say about all this and all the risk and opportunity, right? All throughout this business that you have here.
Yeah.
It's wonderful to go through it with you all in detail here. Um, I'd I'd ask, Nevada again. Is it possible to go there and do something that other people aren't doing? Is that
Um.
is that a possible niche or approach to that market, right? Like, I think there's gonna be a lot of
Yeah.
growth in the drilling
Oh, for
market in
sure.
Nevada.
Yeah, no,
And
no. We like US for sure. I mean, North America, I would say overall, has we've all seen capital. I would say flow back to North American. It's higher
yeah.
cost, but end of the day, the rules, the laws. You deal with the
Well,
First Nations, you deal with environmentals. Assuming you do all that on the checklist, the project is going to go ahead,
yeah.
especially on good economics, right? So I think that's a dependable premium people are paying, and
I'll say again, doing, do different things in regards to minerals exploration too, is what I should have said, right?
okay,
There may be a growth area there for people who want to do seismic imaging,
right,
in
right, right.
Nevada as part of gold exploration projects or things like that, right? It's
For sure.
uh
Yeah, no, I mean, we're always looking at different technology improvements to our drill rigs, to efficiency as well. I can't say in the immediate future there's anything in Nevada for us, but I mean, you're not the first one to certainly point out the potential of Nevada to us. There are definitely ideas we're working there too, where we are always, concurrently looking at different client bid requests for majors and mid caps across the world. If the numbers make sense. And as I mentioned, it is a saturated and very well served market. It is a
yeah,
good market and very big market. But again, there are a number of drilling companies there too. There's Capital Drilling. There's I think it's called Standard Drilling. There's of course Bort Longyear, and First Drilling, which is owned by RCF, Resource Capital Fund. So it's a well served market. I mean, it's a very mature market. You're gonna get obviously very competitive rates. So as a newcomer in that sector, I'm not quite sure we can make a huge meaningful impact. Just being honest, but yeah, I mean we do have excess capacity, so we're certainly looking around for more ways, kind of like how we created a second season in
yeah,
geothermal and geotech. Not to say mining isn't growing, but I think realistically that there's a lot more growth coming from everything else.
Okay. Yeah, I hear it loud and clear. It's, I wonder about the umbrella sort of these organizations, right? Like
Yeah.
there's a bunch of entities here that are doing different things and they're working together various ways. I wonder also though about how, Energold itself kind of fits into broader corporate positioning, there in your office and at your group.
Right. I mean, we have that approach, obviously, in the interest of cost saving. I mean, we have
Yeah.
in-house accounting, legal counsel, and everything else for all the countries we're getting receivables and billings from. And that's to even stay on top of that. It's unfortunately a bit of a maintenance cost. Overall, we've been able to reduce G&A quite a bit the last few years. We've cut it down by another 15% recently, going through the same model really as manufacturing, doing more with less. Really, that's what it is. But again, that's one thing we have to caveat. I mean, there are a lot of competing industries showing growth, and you can only cut so much. I would say 10, 14% of G&A versus revenue is pretty fair, given the company of the size. I mean, nearly 90 million revenue a year. Um, so the easiest way to really get close, and we are very close. We did achieve positive EBITDA 3/4 of the year without Q4, and within net income, almost within grasp. I think the easiest way we can all agree, Peter, to make money is to get more business rather than cutting costs. I mean, we've cut costs where we can. We're trying to do more with the same amount of people. We're certainly not hiring more. There's a lot of idle drillers and consultants in different countries chasing business. We are seeing business growing, and that's something we can't dispute. Last 2 years, we've seen a growth of nearly 20 million in revenue. That's a 25% jump from 2016. So about 12, 14% annualized increase. We're forecasting the same increase in 2019. So in 2019, we should surely be close to net income and certainly net positive EBITDA, which at the current valuation of 15 cents, 54 million shares out, Energo has never rolled back in the last 25 years that it's been public. That's an amazing feat. I mean, insiders own over 15% of the shares.
Yeah.
We have Sprott, Extract, Vertex One, Doug Casey is an investor. I mean, so we have a good roster of investors that are long term. We have Franklin Templeton, who's been selling a little bit, but they had about 8% of the stock not long ago. So it's certainly ripe for a turnaround. It's just that I think we need to market more of the non-mining story right now, and really just show that people this is a different company than what it was in 2012.
Yeah, and cash flow is cash flow, and something that's growing at something that is 90 million, talking about 25% growth rates, and that should just interest investors, period, right? Like there's a global audience for cash flow like that.
I agree.
A lot of those buyers don't necessarily understand, the kind of risk that might be implied with parts of some of this cash flow, right? Like the minerals exploration business, really marginal, questionable, boom, bust. But if this sustainable drilling stuff that you're talking about, if that's more of a steady growth story, related to urbanization and stuff like that, that's an investable thesis for all kinds of people, right?
That's right. Yeah, I mean, and just to look at the share price where it is right now versus where it was and where it has been, Peter, it's probably the simplest way for a lot of retail investors to look at this. I mean, we have a working capital of over 40 million last quarter. We've cash of 5 million. We have receivables of over 13 million. We do have a convertible debt next year due, but on a company that's 6-7 million market cap, where we can sell small divisions for $5-10 million cash today. Like how this has got to be a pretty good risk-adjusted reward bet on not even mining, just on a simple business. I mean, your downside here.
The convertible debenture there of 17, like how does that convert related
the conversion price is 85 cents. That's convert. That's
and you're trading at 15 cents, did you say?
Yeah, we signed that convert in 2017 when we were trading at 70 cents. So the
Good,
conversion was a
good.
lot smaller in terms of the
Well, and
premium back
it's yeah, but it's not a disaster in terms of dilution, you know, like
then. No.
it's it's company positive probably overall to have it at that price.
Oh, for sure. It means it's great for us to get it when we got it. It
Is it
is
to
paying.
a related party? Is the holder of that still a shareholder otherwise?
It is, yeah. So Extract is a fund in New York and Toronto. They have about 14 million of that. Insiders, management, directors, board chairman has about 2.8 million
Yeah.
of that convert. So there's certainly skin in the game. We also have Sprott on board as part of that too.
Well, that's such an interesting, you know, piece of equity there, right? That's not a majority position in the company, it doesn't sound like.
I mean, in terms of the valuation, it would be material.
Yeah, but I
It'd be a
mean in
very
terms of
big
the
chunk.
equity share count. No, I mean in terms of
No,
the
not really.
equity share
No, no,
count.
for sure. Yeah, I mean, and there is a dilution clause as well. I don't think they can convert for more than 20%
Oh, yeah,
of
so
the outstanding
and
share. So yeah, they can't just convert at the market cap because that's a very deceptive.
but
Just because we have
but
so little shares out.
does it just change the position of who holds controlling interest though? Like if they're getting 18 of that 20%, does it, you know, give them a 51% block considering their other
Yeah.
holdings
So
there?
Extract does. They do represent though. They certainly do represent the convert note holders, so to speak. So they have basically 14 million out of the 20, and even and they have both the majority and also the, I guess, the deciding factor, if you will.
Yeah. Well, it's all these issues around corporate control, right, that are so important and so interesting and really hard to understand from the outside without, you know, being super
Yeah.
familiar with it, right? But
No, fair enough.
uh, how is the board? You know, there's no, I haven't heard of any, you know, Discord or public fighting things recent
No, I
ever.
mean the board is very supportive. Our board of directors, if you kind of go to the PowerPoint on one of the pages, you'll see that Fred is the founder and major shareholder of the company still. That has not changed. We then, of course, have Jim Coleman, who's the chairman and director. He's a partner of Norton Rose, one of the largest law firms in the world. We have Brian Bertram, who is actually the founding family member of Bertram Energy Services,
Yeah.
which is our oil sands division. We have Mike Bealey, who's one of the early co-founders of B2 Gold and BEMA, which is, you know, why we have a very good relationship with B2 Gold and the group of companies there. We have Mark Cora, who used to be the former CFO of B2 Gold as well. And then we have Alistair McBain, who is a senior consultant and longtime board members of subsidiary companies to
Yeah.
Shell Energy.
Yeah.
So
It's
um,
amazing. It
yeah,
sounds
so
like there's hundreds of people working under this company.
Energold in North America. So in Alberta, we have about 150 staff
Yeah.
for the energy division. Montana is probably about 40 or so. A lot of it's contractors and short-term employees. We in Vancouver we probably just have 50 people. But overall, consultants, full-time staff, all added together, I would say easily 1,200 plus around the world. But again, a lot of them are, you know, short-term laborers. You know, it could be laborers in Africa in a nearby village. We're paying fair market rates. We train them on how to use the rigs and everything else. So yeah, it's certainly not a small operation. I mean, it is a company that's doing over 84 million in revenue, right? That's not
Yeah.
a Yeah, it's not a small operation.
Is the if there's the is there the potential to grow, you know, significantly with capital, right? Like if is
Yeah, yeah, for sure. So I
10
mean,
million
we
more,
are
like 100
we've
million
only raised
more.
money. Yeah, we've only raised money a handful of times, and that's where I urge some of your investors. If you look at the PowerPoint deck, Peter, I mean, I can share my screen maybe, but it's you know, it's 15 shares right now, 15 cents a share right now in the market. In the right environment, this was a $5, $6 stock, and that's actually been the case a number of times over the years, actually. So it's really just the sentiment of the market right now, very negative, unfortunately,
Yep.
and I'm sure that would start changing. If you kind of look at the share price right now, 15 cents, 54 million shares out, never consolidated before, puts us at a market cap just over 8 million, with a decent amount of working capital. Like it's a very skewed trade from the side of basically whoever's buying the shares. If you kind of look back at the share price count over the years, the company has done very well in terms of continue to grow the business, even though the market hasn't been very kind. So if you kind of look at this page, can you see the chart, Peter?
It's sharing my screen, not yours.
Oh, okay, never mind. Okay.
Which page?
I thought I was sharing. Am I sharing? Okay, now it's sharing, right?
No, it's me, I'm afraid.
It's still you, hey? Oh, yikes. Weird. How do I share my screen?
Oh.
I thought we have it shared here. It says down. Peter being sharing screen. Okay. Oh, thanks.
Technical difficulties.
Yeah, that's fine. I mean, if you go on the website, you might be. Oh, there you go. You're going through it. Perfect. Yeah. If you just go back to some of the first pages up there. So these are just our financials over the years, and in the right market in 2009 to 2011, business would double year over year just on drilling alone on the mining side. If I can ask you to maybe go back to page 3 or 4 of this presentation on the website. Yes, I mean, you can see energy, mining, infrastructure is kind of our breakdown right now, our geographical breakdown. Canada, Africa, Mexico's our top dominant markets. Mining is less than 50% this year. If you go to the next page, you'll see that our core business is in frontier drilling, specialized drilling for various top level and mid cap companies. It used to be 80% juniors. Now we're 70% senior developers, 10% mid caps, maybe 20% juniors, and these are highly successful juniors that can raise money in today's market. Yeah. If you go to the next page, I think you'll see a corporate overview of our share structure. Sorry, in the next page as well. That's our global snapshot. Yeah, so the mining trend here is you can see that our stock price and chart really follows this trend quite well. Mining expenditures at a bit of an all-time low, going back as low as 2009 during the financial crisis, as low as 2007, before the gold price really ran up. I think this year, 2018, wrapped up just over 9 billion. So it's improving. It's not getting worse, at least. So we should see that continue to flow down and trickle down. If you go to the next few pages, I'm trying to find the stock chart here, but this page is good because, I mean, you can see that the world needs more oil. Hydrovac drilling is there. Probably the page after here. There you go. So 2012, we were a $6 stock trading at 5-6 times EBITDA and doing 140 million revenue. That year and the year before, we did 133. So things did not really start falling until really 14, and 15 was probably the worst year. And in addition to that, back then we were doing 100 million on mining. The rest was just gravy on top from oil and gas, bit of a seismic, bit of a geothermal. That didn't really even exist back then. And you can kind of see the cash balance just unfortunately whittled down over the years. So we've been able to survive this downturn through diversification. We've limited capital raising. The last capital raise was in 2016, where we raised $6 million at $1. And 2012, TD gave us a bought deal at $5.40 for 20 million.
Yeah.
So we haven't raised money very, very often. We have to do what we have to do right now in the markets. We do have a bit of cash, some working capital and receivables, but I mean, we're looking at increasing revenue. We need to raise money to keep operation growing. That's how we can turn this into a profit. And we're very close right now. So you can see the losses are narrowing significantly. The adjusted EBITDA is close to break even, and operation cash flow is starting to be positive for divisions. But again, the crazy thing is our market cap is less than what we were in 2009, like 10 years ago, when we were doing 20 million a year.
Yep.
So the average market cap back then, I think there's another chart, maybe the page before or the page after. Yeah, there you go. So the average market cap, if you look right now, we're back to as low as what we were in 2005.
Wow.
So the KPIs are looking up. Mining is not even our main business right now. There's clearly a rationality price in here. The adjusted EBITDA was positive this year, earlier in Q3, which means we're trading at not even 1x EBITDA. Basically, it's or I mean, sorry, double, 2x EBITDA. I mean, at 5-6 million market cap. And as I mentioned, we hold shares in junior companies too. We hold 8
Yeah.
million shares of Impact, which is trading at 30 cents. And we hold, we sold our manufacturing division for just over 5 million Canadian.
Yeah.
Between those two assets, that's
Yeah.
pretty much the market cap. We have no value for the business at all.
Yeah. Which is great. And the potential to do some, financial engineering from that position is so huge, right? If you
I would
could,
hope so. I mean, the good thing is that, Peter, as you said, I mean, we're not just dependent on mining coming back. I mean, look at the price to book value, the next page, versus our peers. We're trading at a huge discount. So, I mean, if you believe that mining's coming back, great, buy Energold. If you believe that geothermal, there's going to be more 4G and 5G wireless upgrades and networks, buy Energold, because there's not many publicly traded geothermal and HTD companies out there, and we're seeing a lot more growth there too.
And can another reason to say what you just said about the geothermal and the sustainable drilling is what's with the losses there, even in those peak years, 2011, 2012, right? With all the drilling activity, is
Yeah,
it?
good question. So the adjusting here, you'll see on the bottom, as I mentioned, we had to adjust for a payout,
Yeah.
right, for the Bertram acquisitions. We were paying 10.5 million a year for 2012 to 2016, plus the amortization. So we paid 15 million in 2011 for the oil sands business. It was written up, it was valued at over 50 million. So amortization on 35 million of additional value over 5 years, it's like 7 million a year in amortization, like, which is non-cash. So that drops us down quite a bit there. And then on top of that, we have an earnout, which if they hit 3 million EBITDA, we pay them three and a half times, which is another 10.5 million.
I
So
want to
we're
see
talking about
those. I want to see the non-IFRS earnings on those things, man. Get
yeah.
away
So I
from
mean,
the.
that's why we have a bit of an asterisk there. Like it's,
Well,
I
and
mean,
if you could show the non-IFRS, like the real numbers for each of those lines, and have them for each
yeah.
line
So
of business too,
yeah, I mean, the
even back
good thing is
then.
that, Peter, I mean, by 2018, the amortization has wrapped up. The earnout wrapped up in
Yeah.
2016 as well. So you see that dropping quite significantly, rather than from 10 million over 10 million
Yeah.
down to about 5, and now we're getting close to break even again on EBITDA, which is huge positive sign. And then of course we still, unfortunately, we have the interest expenses from the convert debt for 20 million. That's costing us about 4.5 million a year. So
Yeah.
that's taken away as well. We would be in the positive. So
Yeah.
we're very close. And the easiest thing is to continue growing the business. That is the
Well,
easiest thing to.
and that number being positive doesn't mean much more than, oh, you're gonna have to pay more, like more taxes, I think, really.
Sure, but hey, I mean that I think at least is a positive affirmation though that this is a sustainable business, which historically we've seen it is sustainable even just on mining. So
And maybe I'd point that out too to anybody who's listening, stuck with us for all this time, right? Is that there's I wonder if in amidst, this headline number that you see, there's various strands of it that are, doing well and could grow substantially with capital applied, right? And the potential for some of the financiers looking for cash flow to like come to the Energold and, talk about spinning out this part or that part and all the, again, the financial engineering that you can do, and that you have been doing, building this company, very noteworthy. And yeah, I wonder about, again, private sidecar things. Are there any off balance sheet things for Energold? I didn't see mention of them in the notes.
no, I mean, so the convertible
Yeah.
debt is probably the biggest one out there. I mean, we've never really had anything major at all that we do anything off balance sheet wise. I mean, we have Energo has been always very above board with anything in terms of financial disclosure.
Yep.
Fred, myself, CPAs, banking background. So and we have loans with EDC. If you bought a rig from Energo in Europe, you can look at this chart. Very cheap enterprise to sales value, EV to EBITDA, sales growth. We're actually growing faster than most of our peers. Most of our peers are actually forecasting drops in revenue, whereas actually we're growing. Price to book value, unbelievable. We're at not even 0.38. So what that means is the share price to our book value, we're worth less than 40% of our book value, right? Which is already an amortized amount. So
And
that's
how
kind of
much is
shows
that
you.
the sustainable drilling versus really
So what that
in
means,
terms
Peter, is
in
this
terms
is
of the
just a
sales growth?
pure. Okay, sorry, sales growth. I would say more than 70%. Yeah, as I
Wow.
mentioned, I think mining actually dropped year over year. So actually more like 80%. So sustainable drilling doubled year over year. Green drilling and infrastructure nearly doubled as well year over
Yeah.
year. So mining actually dragged that down.
And are those two lines are they positive?
Yeah, they're positive
Cool.
cash flow.
So you have
Yeah.
the fastest growing. It's something that's near like almost getting into 100% plus growth rates annually, and it's
Yeah, but I mean,
profitable.
so yeah, if we were purely diversified drilling, oil sands was up 50%, right? So it went from 20 million to 30 million.
Wow.
I think the green drilling, just off the top of my head, was 17 million this year versus or
Nice.
18 million versus 9 last year. So it's over 100% growth year over year. So mining went down from 45 to 39.8, I think. So it actually dropped about 10-12%. So if anything, mining dragged us down.
Yep. Yep. Totally. Well, and that's often the way it is, right? Mining is
Unfortunately, yeah, yeah.
pretty
Yeah. I don't think it's going
and
to get worse, to be honest. It's just that it is challenging right now to raise money all of a sudden again. So
well, and the
that's
only
not.
question maybe I'd ask you about mining would be
Yeah,
if a boom came, if there was a boom of orders and stuff,
yeah.
work available in the areas that you kind of accommodate for minerals exploration, right? Like, would you be able to? I guess you have enough slack that you would be able to
Oh yeah,
accommodate a
no
lot of.
problem. Yeah,
Okay.
we can service that very very fast. Be assured. Yeah.
Do you have how's your growth capabilities too? Like, if somebody came to the table with like $20 million to like do some crazy
Sure.
project
Yeah, no,
and
it's definitely there. I mean, so case in point, we're drilling for Endeavor Mining right now, and this is like a 6+ rig operation. So it's been a while since
nice.
major mid caps have committed to programs like that. And keep in mind, there's a rainy season in certain countries, so Africa. So if you have a 40,000 meter contract per rig, you're only getting maybe 60, 80 meter per day, right? 2 shifts. So if you do the math, if you're drilling month round, you're not going to finish the work in time. So you need multiple rigs on
Yeah.
site. So that's basically how that works, right? Like you have time is of essence, right? I mean, for juniors and also certainly more so for mid cap and majors, they're not
Yeah.
just drilling for exploration. They're drilling for brownfield. They need to
Yeah.
drill so they can continue to produce.
It's a terrible way to make money.
Well, hey, it is a depleting stock base. So every day you're producing ore, you're selling concentrate, you're depleting that resource and reserve in some cases. So
Yeah.
you need to continue to push ahead with brownfield drilling. I mean, the infrastructure is spent already. You're trying to go around the pit, digging around to basically increase your mine life and your life of mine because the money is spent already. All you're trying to do is find ways to stay around and continue to operate that longer.
And
So this last stage is our continued growth strategies. We're stabilizing our growth market, Peter. We're finding more business where we are already. We're not really looking at new markets for mining. The main thing is to let's see that significant sign that it's back, like 2016. It was a bit of flash in the pan. Mining came back, but unfortunately, when the money is raised, nobody goes out and drill right away. They're paying down their debts owing to them for salary and overhead the last 2-3 years, and then in 2017 we saw that drilling coming back in terms of programs. We're growing our oil and gas. We're seeing oil sands and oil markets improving. hopefully with more clarity. We're seeing oil sands returning in terms of activity rates, and we're finding that second season, as I mentioned. This second season is becoming more and more material, which is great. And lastly, just growing that infrastructure side of the business.
Yeah, it's wicked. I look at this image in the center and I wonder about, research and development and like testing new types of drilling, procedures, or developing new equipment. I don't,
Mhm.
or even just doing things that you know how to do from one area, trying
Right.
those in a place where people don't usually use them. Um, it's all just a question of budgets, I guess.
Yeah,
But
yeah. I mean, we would love to do more research and R&D, and this photo of the shop floor we have of the manufacturing business in UK. So they have two aircraft hangars there. They've been
mm,
around actually for 150 years, 151 now. So it's older than Caterpillar. It hasn't really grown. We bought it in 2011, almost bankruptcy.
yeah,
We tripled the revenue to a peak of 24 million, I think, in 2014. Unfortunately, mining, geotech slowdown, and
yeah,
just apathy, I guess, in the market really crumbled the business books there. But they were they actually drilled the first fresh water wells in UK during the cholera, the Black Death outbreak in
wow,
London.
yeah,
So this company was awarded, various medals by the Queen. It's called Dando. It's well recognized. It has a UN and World Bank certification to sell water rigs in Africa. It's a great
mm,
company. We have
oh,
great
imagine that.
relationships.
Yeah,
Yeah, we have great relationships with the guys that bought it. I mean, as I mentioned, they pay us out 5.3 million over a period of time. So we're still transitioning it, and I leave a photo up there because they have very talented engineers and sales staff. They are concurrently always improving their products, and as I
yeah,
mentioned, in the last year, after this new group started taking over and we found a new team of management. We turned the business around very, very fast in the
yeah,
last
yeah.
7 months. 40% growth year over year, net margins 25%. It's actually, yeah, I mean, it's sad to say we just sold it, but I wouldn't be surprised if in a few years the company is a bigger company than we sold it.
Do you have any residual interest, or is that
No,
$5.3
yeah,
million payout complete?
yeah. It's also, I mean, so
Cool.
we sold 51% of it for the initial consideration, and then as I said, I think every 9 months we get paid 750, 800,000. And then, I guess at the end of that cycle, we transfer the remaining 49%.
Yep, sure. Yeah, you think about a minerals exploration project, and anybody who held it and sold it, they'd put an NSR on it and a royalty, which is somewhat of an encumbrance. Um, it might be nice to have a royalty on that company potentially,
Oh, I know.
but
Yeah, yeah.
but it's not, a feature necessarily that you see a lot in broader, in all areas of business, I would think. But thinking again about somebody who could come to a situation like that, apply capital,
Yeah,
let the business kind of be run by the people who run the business, underwrite some serious growth potential and new ideas. And yeah, it's good to see, that you guys are somewhat involved in another scenario where some of those same ideas kind of appear quite clearly. A lot of potential high
yeah,
impact
yeah.
investment
That's great.
scenarios.
Yeah, no, thanks for going so into the details, Peter, with us.
My pleasure. You're welcome. Let's turn off the recording here. Thanks to
Perfect.
everyone who listened. Goodbye.